Thank you for watching Series 1 of Master Later Life Lending. Series 2 is just around the corner, but topical at the moment is interest rates, the impact of the budget, and that's really at the forefront of advisors' minds. So today we have with us Roland Steer, who is Managing Director for Asset Management at Key Group, to help us navigate some of the really current questions from advisors on what impact interest rates will have on the later life lending market. So Roland, the first question, what do you expect the impact of the budget to be on interest rates in the equity release market?
Hi, Paul. Thank you for having me. As you say, there is a big budget coming up, one that's been eagerly anticipated. As ever, we don't quite know what the Chancellor is going to say in her budget before she says it. I think the hope is that a lot of this will be foretrailed before she says it, released into the market and tested, if you like. And if she does that, then that should avoid some of the big market shocks that we've had, for example, with the Liz Truss mini budget a few years ago. In terms of the content, I think she is considering relaxing some of the fiscal rules, which would allow her to borrow more. And that will be closely scrutinized by the bond markets. If she missteps, if the bond markets don't have her trust, there is a real risk that things could go much higher, which would probably be bad for the equity release market and interest rates in general. The hope is she won't. The hope it will be much more constrained, but let's wait and see. I think as much as anything else, there will be impacts on the demand side as well, though. Who is she going to come after with those tax rises? How's that going to affect growth in the economy? So lots to play for in both directions, but probably a risk to the upside on interest rates that we'll be watching carefully.
Thanks, Roland. And a second supplementary question on that. What can you tell our viewers and listeners about the recent comments from Andrew Bailey around how interest rates may be cut more aggressively than expected?
Yes, absolutely. So earlier this month, Andrew Bailey, the governor of the Bank of England, came out with some comments to say that perhaps the MPC would be more activist with regard to interest rates. And the markets tend to react well to this kind of forward guidance from people with inside knowledge. Indeed, earlier in the summer, when Andrew Bailey made comments before, it did foreshadow a cut in the base rates that we saw. I think it is a piece of information, though, and we need to consider all the pieces of information. For example, further that week, you had Hugh Pym, who also sits on the MPC, also has a vote like Andrew Bailey does, suggesting that the MPC should take a much more cautious approach. So net of those two things, I'm not sure it really moved us that much further on. However, that was early October. The mood music in the market at the time was that there was the potential for a jumbo rate cut across the pond in the States, up to 50 basis points, and that perhaps Andrew Bailey was talking about a similar move over here. Since then, we have seen some data in the US about the jobs market, which shows that the economy is booming. And those thoughts of a jumbo rate cut in the US have absolutely diminished. What's more, we've had escalation in the Middle East with a big increase in the price of oil. That has been inflationary. And actually, net of all the information we have seen long-dated cost of borrowing go up since those comments. So it is important that everyone has in their mind that the Bank of England base rate is not the same as long-dated cost of borrowing, which is what drives the equity release market. It is one factor. We welcome all the information. But since those comments, we have seen rates go up. And I think if it hasn't already, we'll probably see that come through in residential as well as lifetime mortgage lending rates very soon.
Thanks, Roland. And then building on that further, what impacts does all of that have for advisors who are dealing with customers in the short term?
It's a tricky market out there, and obviously the advisors will be well placed to deal with their individual customers' needs and their expectations. I think it is always very difficult to try and second guess the markets or try and guess when rates are going to be high or low, other than the immediate short term, where I can confidently say I think rates are going up. Where are they going to be in 3 months or 4 months? It's probably equal chance that they are higher or lower. So I'd absolutely make sure that the advice is tailored to those customers' needs. Do they need the money now? Will they need some money in the future? What I would say, though, is that the products have become much more modern and there are a lot more options out there now. So, for example, if people are able to service some of the interest, they can get much lower interest rates. Furthermore, if they are worried about locking into to rates for a very long time. There are products out there now with very low ERCs, which wasn't the case a few years ago. Indeed, now there are some products out there with no ERC. So they should be factored into the equation as the advisor tries to navigate what is a very difficult landscape, quite frankly.
Thanks, Roland. Thank you for joining us today. I think the insight on what is going to be quite an important few weeks for advisors in how they support their customers has been really helpful. Really appreciate your time today, and we look forward to speaking to you on future episodes.